Good afternoon and welcome to the IMPAX Environmental Markets PLC investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Tom Morris-Brown. Good afternoon to you, sir.
Good afternoon. Thank you everyone for joining this presentation on IMPAX Environmental Markets PLC. As said, my name is Tom Morris-Brown and I'm a portfolio specialist here at IMPAX. Joining me today are Glenn Suarez, IEM's chairman, as well as John Forster and Fotis Hadjimitolakis, co-portfolio managers on the trust. We expect this presentation to last around 25 minutes. That should leave plenty of time for Q&A at the end. So with that, I'd like to hand over to Glenn Suarez, Chairman of the Board, to begin the presentation.
Good afternoon, everyone, and welcome. Thank you for making time to attend this presentation this afternoon. As you've already heard, I'm Glenn Suarez, Chairman of IMPAX Environmental Markets, or IEM for short. In a moment, I'm going to ask John Forster and Fotis Hadjimitolakis, our portfolio managers, to take you through the results and the prospects for the company. But before I do that, I want to make 3 points that you should bear in mind when you listen to them. Firstly, this is a thematic trust that focuses on investing in companies which are developing more sustainable ways to provide critical needs such as water, food, energy, and housing. This is one of the mega themes for the rest of the 21st century. And we are the only investment trust in the UK market, and possibly on the European continent, which offers investors broad spectrum exposure to this theme, both geographically and in terms of the subsectors that make up the environmental markets. If you'll allow me to say this in a technical way, the company offers diversified, non-correlated exposure that could be part of the toolkit for managing market risk. That's the first point. Secondly, over the past decade, the earnings of companies in IEM's portfolio have been growing faster than the earnings of companies in the broader market as a whole. We believe this trend is likely to accelerate in the future, not just because of customer demand for a cleaner environment, or convenience for that matter, but because there is a technical revolution taking place at the same time. This means that many companies in our focus area can deliver at lower cost than in the past, or indeed compared to more traditional companies. You only need to think of a company like Cattle, which is in our portfolio, which announced on Monday that it was going to start production this December of sodium batteries. These are much cheaper and safer than lithium batteries and promise further reductions in the price of electric cars and lower costs in the management of intermittency risk of renewables worldwide. Thirdly, in the third and fourth quarters this year, in preparation for this year's AGM, our board consulted with shareholders on their expectations and on the changes they would like to see for the structure of the company. And these fed into our strategy deliberations in October last year. In addition, the board undertook a thorough exercise to test the suitability of the manager to continue in this role. This involved both a qualitative review as well as a quantitative review, which looked at the manager's process for stock selection, risk management, buy-sell discipline, leverage, and things like that. We also looked at the manager's record in choosing companies based on their own forecasts of earnings growth versus the outcome. This, of course, is a key test of manager skill. As a result of these investigations, we, that is to say the board, and the manager have identified a number of changes that we believe can drive performance improvements. But in terms of the big picture, it's clear to us that IMPAX has the research depth, the talent, and the financial resources to continue to create attractive risk-adjusted portfolios for investors. Now, we recognize that performance over the last 3 years has been very challenging, but this is not because the companies in the portfolio have been weak, but rather because the market has been underpricing them and their prospects. That appears to be changing now, and there is an exciting prospect given the discount and a modest degree of leverage as the market begins to align valuations with earnings fundamentals. I say all of this because we have a continuation vote coming up at this year's AGM, and the board is strongly recommending that you, as shareholders, vote in favor of this. So that's all I want to say at this stage, and I'll come back at the end, but I'm going to pass over to John and to Fotis to take you through the presentation.
Thank you very much, Glenn, and hi, everyone. First of all, apologies for the lack of camera. Just when we thought we had technology sorted out, my laptop decided to crash just before the webinar, so sorry for that. If we could please start with slide 6, Tom. So let's maybe start with a reminder of the investment thesis behind IEM. So in a world with finite resources and constant demand for higher living standards, we believe that companies enabling the cleaner and more efficient delivery of basic needs like water, food, energy, and also companies addressing risks like climate change will grow earnings faster than the global economy. And in the long run, this should be reflected in superior stock returns. So IEM is really all about giving investors pure play exposure to this very attractive growth opportunity. And by pure play, I mean investing in companies that derive the majority of their revenues from these growth areas that I just mentioned. If we go on to the next slide, please. Obviously, the past couple of years, the world has been a lot more volatile and performance has been challenging, as Glenn mentioned. But it's important to remember that IEM has been going on for about 25 years now, and the problems that it was designed to address haven't really gone away because we have a Trump administration in the US or because everyone has been focusing only on AI in the past couple of years. Sadly, we still have global warming. We see more and more extreme weather events that are very disruptive and expensive to deal with, and that is putting pressure on water and energy networks. These are multi-decade issues, and there is a massive need for investment, which creates opportunities for the companies providing the solutions to these problems. And I think that's something important to appreciate, that we're not investing in nice-to-have policy-dependent products, but in mission-critical solutions that the world absolutely needs today. And these solutions are being provided by proven, profitable companies with proven and profitable business models that we invest in IEM. If we go to the next slide, please. I think this is a very important slide because it illustrates the core of the IEM investment thesis. We don't have yet 2024 complete data, so this stops in 23. But what you can see here is that over the long term, IEM has been delivering superior earnings growth versus global equities. So we can really see the thesis playing out. Of course, nothing is a straight line. So over the 3 years, we have had once in a lifetime disruption in supply chains after the COVID boom. And we've had also outsized earnings growth from mega cap AI companies that are not in our opportunity set. So that has meant that on a 3-year period, earnings growth has been just below WACC. But as I said before, IEM has been going on for a quarter of a century. And during this time, we have had periods when our markets went out of favor. But what eventually happened is that the portfolio companies eventually re-established themselves as high-quality businesses with superior earnings growth. Something else that's interesting to note here is that over the 3 years, earnings growth has been just below MSCI ACWI, just below global equities. But at the same time, we have seen a very aggressive derating of IEM compared to global markets. which has left IM valuation at historically low levels. If we go the next slide, please. The next slide looks at what happened in 2024, and I appreciate now that's almost 4 months ago, so I will only make a few key points here. But the main message to take away from this slide is that the headwinds we have faced last year have largely played out. So point number one, and at the risk of stating the obvious, mega cap tech and financials are not really in our opportunity set. They're not the types of companies that we have in IEM, and this has been a very material headwind versus ACWI that we can't really do a lot about. But we have seen that reversing this year. We have seen signs of a broadening market. Second point I would make here is that it's been a very tough time for renewables for a variety of reasons. Where we are now is that we have exited equipment manufacturers and we have consolidated our exposure in project developers that trade at historically low valuations. Towards the middle of this slide, we're calling out some challenges around destocking and life sciences, and these have now largely normalized. There were leftovers of the COVID boom and the subsequent crash of supply chains. Of course, that's now pretty much fully played out. And the final point I would make here is around mergers and acquisitions. Historically, M&A has been one of the drivers for IEM, as large companies have bought their way into our markets by acquiring portfolio holdings. There has been a bit of a pause for 4 or 5 years, but in 2024 and so far this year, we have had 4 holdings that have been M&A targets. So that goes again back to the point that the portfolio is trading at historically low valuations. If we go to the next slide, please. This is a snapshot of the portfolio as of the end of 2024. I will not spend a lot of time here. Just some key points to make are that we do have a structural overweight in industrials. I'm looking now at the top right-hand side at the geeks sector allocation. So we do have a structural overweight in industrials, and the other key sectors for the portfolio are IT, materials, and utilities. So these are sort of the key sectors we have exposure in IEM. In terms of our regional exposures, we have about 55% in North America, 32% in Europe, which effectively means that compared to global equities, we are underweight North America and overweight Europe. And that is looking at the country of listing. Of course, we do invest in global companies. So if we look at where the underlying revenues come from, it's a lot. We are a lot more balanced compared to global equities. If we then go on to the next slide. So over the next 3 slides, we thought it would be a good idea to talk to you about some of the themes we are excited about, and also give some examples of what do these companies actually do. And I will start with the first theme, which is digitalization. It has been an area of growing prominence within environmental markets, and that trend started about 10 years ago, around the same time I joined IMPAX, actually. So if we go back 10, 15 years, when we wanted to do something more efficiently, we always focused on improving the performance of hardware. So make it lighter, make it run faster, increase precision. Now that has been changing, and the incremental wave of efficiencies are more and more coming from using software and using data to generate actionable insights. And that's creating some very interesting investment opportunities from an environmental markets perspective. And a good example of such a company is Bentley. You can see that on the left-hand side in this slide. So this is a company really digitizing the construction industry. Construction is amongst the least digitized sectors in the global economy. I studied civil engineering at university. I have spent some time in construction sites. So I have seen how inefficiently projects are being run. The statistic that's out there is that about 20% of the materials ordered on a construction site ending up being wasted. And I'm sure if you've ever had building works done to your house, you have probably seen that. So there is a massive opportunity from an environmental markets perspective to improve efficiency. There is also an existential issue for the construction industry itself, which is lack of labor. And that's because younger people see this sector as very manual, not very attractive as career choice, and that is creating a shortage of available labor for the construction companies. And that means that there are some pretty interesting structural drivers that support higher penetration for Bentley software. And then another attractive characteristic I would highlight here is that Bentley sells its software using a subscription-based revenue model, which adds more resilience and defensiveness to the whole story. So that was one example of digitalization, and now I will pass to John to talk about some of the other themes we're excited about. Thank you.
Oops. Okay, so Tom, you're moving the slides. Thanks for that. So good afternoon, everyone. So onto the second theme is one of electrification. At the front of the presentation, we talked about forecasts for up to 50% demand growth for power between now and 2050. That's the International Energy Agency, so a very credible organization. For the avoidance of doubt, those are massive numbers in a world where power demand's been pretty flattish for many years. So this is a big deal, and it creates a huge amount of opportunity for us as portfolio managers, and it's through the whole value chain. It starts with the renewable power project developers like Ormat, you can see on the top left. It continues through the necessary expansion of the grid with the likes of Prysmian, who make cables that go into strengthening grid infrastructure. And then it extends into companies that are providing the technologies to electrify end markets. So we're talking heating, ventilation, and air conditioning. We're talking in transportation markets and across broader sections of industry. So there's a huge opportunity. If I was going to pull a name out, it's actually one that Glenn has mentioned already. It would be CATL, Contemporary Amperex. To give you a little bit more detail on it, it's the leading battery manufacturer globally. It has about 40% market share across relevant markets. It's very strong both in electric vehicles, but also broader energy storage. It's dominant in its home market of China, and it's a key solution provider into Europe as well. It's an industry where scale really matters, and their scale provides them with some fantastic advantages. The first is in manufacturing. So their scale gives them the ability to invest in automation. It's a highly automated company, which gives them cost advantages in manufacturing. And the second is in R&D. This is a company that spent $2.5 billion on R&D last year. It means that they're at the forefront of all of the different chemistries within battery development, and it's leading them to announce the kind of advancements that Glenn was talking about earlier on. The one he didn't mention is they've announced a new lithium-ion battery that can charge 500 kilometers worth of charge in 5 minutes, which is a huge number, quite frankly. So that is one of the investments within the portfolio, but hopefully you can see from this slide that there are many opportunities around electrification, and this is very early days. So if we go to the next slide, we're talking about climate change adaptation. No one really wants to talk about climate change anymore, but at the end of the day, the science is no longer in doubt, and the financial implications are also very real. We've talked about that's actually $368 billion of climate-related damages and losses that were caused in 2024. That's the 9th consecutive year of 300 billion plus. and it's 50% above the average since the start of the 2000s. So this is very real, and what it means is a massive investment requirement in order to adapt to a more volatile and changing climate. So again, there are multiple different opportunities for us, everything from backup power for when the grid gets taken out, efficient HVAC products for cooling in a hotter environment, kind of the need to invest heavily in water infrastructure, whether it's stormwater management or broadly across water infrastructure, and also finally, the need to clear up after these massive hurricanes and storms roll through sensitive infrastructure. So that's where Clean Harbors comes in, which is the name I was going to draw out very briefly. They are the dominant US player in industrial hazardous waste management. One of the services they offer is emergency response, which is where they go and clean up after disasters. So if you remember the BP oil spill, Macondo, any of the hurricanes that have rolled through the Gulf of Mexico, they're heavily involved in cleaning up these disasters. Clean Harbors, as I said, is dominant in its market in the US. It's got a 65% market share of the hazardous waste incineration market. It's a very highly regulated industry with very strong barriers to entry. It's almost impossible to get a permit to open a new site. What that means is it gives them a lot of pricing power and the ability to grow earnings. So notwithstanding all of that, there are other drivers for growth, including onshoring of manufacturing in the US, which I'm sure you've all seen. There's a lot of closure of capacity of in-house treatment plants within their industrial client base, and emerging opportunities in the likes of PFAS or these forever chemicals that you may have heard of. So plenty of opportunities, very strong business, and a top 10 holding in the portfolio. So with that, if we move on, so as we said, we're not happy or satisfied with the performance of the strategy in recent years. I would say it came off a high base, and that Fotis has tried to address some of the reasons for that performance. But what we have been doing over the last 6 months is undertaking a deep review of the portfolio and undertaking a dynamic renewal of the portfolio that we have. So in terms of what we're looking for, you can see the focus areas that we've just been talking about in sector terms. Each of those has 15 to 17% within the portfolio. In addition, we have been looking for new defensive opportunities and for value in an environment of increased kind of geopolitical and macro uncertainty. So that's what we've been focusing on. Outside of that, if you look at the bottom left, we were looking at sectors that had proved themselves fragile, whether it's the sector itself or the business model of the companies. We were seeing the escalation of these trade war and tariff uncertainty. So we are looking at manufacturing footprints and how suitable they were for the new world. We've been sharpening our pencil in relation to valuation discipline, which is definitely a learning point over this kind of last 3 years. And in addition to that, we were looking at small positions within the portfolio on the basis of up or out, basically. So as a result of all of that, we have taken significant action. We boiled the portfolio down from 60 to 55 holdings. You can see we had 6 new positions and 11 exits, which were done in the first quarter. We're very pleased with the quality and shape of the portfolio we've ended up with. It does have a higher weighting in the top 10. It's gone from 25 to the high 20s. It's improved the quality of the portfolio, taking the return on equity up by 3 points to 17-18%, and with similar risk characteristics. So we're very pleased with this portfolio and looking forward to take it through into the next cycle of performance and markets. Talking of which, in terms of quick update on performance, Q1 was a difficult period with the escalation of trade wars in March, and obviously carried on into April. The trust was down 7.8% in Q1. That was 3.5% behind ACWI, the MSCI All Country World Index, but broadly in line with the MSCI ACWI SMID growth. So if you look at our style and size bias, then we're much more in line. And if you compare with our sector comparator index, the ET100, which is going to be replaced, we were 4.5% ahead of that index. So challenging markets. I would say April so far is looking actually better, but that's a quick update on performance and where we stand in these challenging markets. So if we go to the next slide, looking to the outlook, obviously the biggest issue and discussion at the moment is tariffs and trade wars. I think the main issue is one of macro related concerns. What does this mean for the global economy? It's definitely damaging to confidence and growth. It does raise the potential for a recession. So we're seeing the sell side with probabilities maybe 35 to 40% and has been rising. So what do we do in that kind of environment? We have been in recessionary environments before. And what we do is we manage our clusters of risk. So we avoid geared names. We had a low tolerance for gearing anyway, but we have reduced exposure to the more geared names within the portfolio. Secondly, we've got cyclical exposures, particularly to things like construction activity, which we've also materially reduced. It's been an area of strength. We were taking profit to stay within our 20% soft limit. We've since reduced that to 13, 14%. In addition to that, I've talked about looking for new and diversifying defensive opportunities, which we've also added to the portfolio in Q1. So I think those are the main risks. Obviously, some people worry about this sustainability pushback and outflows from sustainability related funds. I think my response to that is that has nothing to do with the earnings of the companies, and we're very confident that they will deliver the goods. So if anything, having been here before, this kind of sustainability pushback and out of favor status, I'm more inclined to say is an opportunity and belongs on the right hand side. Speaking of which, in terms of strengths and opportunities, I've been working on this for 23 years. I firmly agree with everything Fotis said, that the growth drivers of environmental markets remain very strong. We are investing in the industries of the future that are providing valuable solutions that will drive growth over time. We've got a really diverse range of opportunities. When we first started, it was very dominated by alternative energy, lots of speculative, unprofitable businesses. It's much broader, more diverse these days, more global, and it's mainly driven by pure economics. So I think it's a really exciting opportunity set we're looking at. IEM itself is pretty unique in these markets, in the investment trust realm, and also in broader sustainability funds. The SMID bias, the focus on pure play companies, is all very differentiated compared to other sustainability funds, but also compared to global equities. So notwithstanding all of that, we are very out of favor at the moment. The valuation is near, we'll come to in a second, is significantly below long-term average in terms of the premium to ACWI. We have a 10% discount that comes on top of that. So if we go to the next slide, that will allow me just to show you what this looks like. So top right is the history of the PE ratio. And I think the way to think of it is we're back at pre-COVID levels, notwithstanding the fact that we've got a different mix in the portfolio with more technology and software. So if you took that to one side, the valuation would be below a long-term average, and the premium to ACWI is currently in the kind of low double-digit percentage, which is pretty much as low as it's been. So we feel quite strongly about valuation. We feel strongly about earnings delivery and growth potential within our industries, and I think with that we'd circle back to the end of the deck to reiterate the points. Next slide. Yeah. Reiterate the strength of our conviction in the outlook for environmental markets and IEM. So I think with that, we probably I'll hand back to, is that to Tom, or?
I think we're going to let Glenn make some closing remarks.
Right. Apologies.
Yes, I mean, I think that, thank you very much, John and Fotis. It's a really good insight into what you do and the portfolio. I think we're going to take some questions, aren't we, Tom?
We are.
So let's do that, and then I'll wrap up with some closing comments.
Okay, perfect. All right. Well, thank you, gentlemen, for your presentations. As Glenn said, we have a few pre-submitted questions, which I will go through and allocate accordingly. There is still time to get those questions in, so if you do have them, please put them in the chat, which should be on the right-hand side here. So looking at the first one, I think John or Fotis, either of you can take this one. What sectors are expected to drive growth, and how are you positioning the portfolio to capitalize on these opportunities?
Fotis, do you want to take that one? I could take the second one.
Yeah. I mean, I would say, going back to what are we most excited about at the moment, it is these three themes that we mentioned, the sort of opportunities around digitalization, climate change adaptation, electrification. So there's a lot of interesting, exciting sort of growth opportunities in there. Then I would also highlight the fact that we have had some sort of sector-specific headwinds over the past couple of years, and as I hopefully explained, a lot of these have now largely played out. So yeah, this is what I would highlight in the first instance. John, anything you would add there?
No, I think outside of these three key areas that we tabled, we're finding really broad opportunities across environmental markets. It's not only there. After the derating that we've seen, the opportunities are broad across all categories. So we're just drawing out some highlights. So otherwise, I'd leave it at that.
Okay. Thank you. Glenn, I think this question is best directed to you. So reads, at year end, the discount was minus 10%, and buybacks don't seem to have closed the gap much. What else is the board doing to narrow the discount?
So the discount rise. So the question is, why does the discount rise? That's the first question. There are some short-term issues, and there are some long-term issues that drive the discount. The long-term issue that driving the discount is a perception of performance. And we've talked about the steps that the board has taken to understand what the drivers are and to position this company to be able to address those. And I'm very optimistic about that. And you've heard John and Fotis about the long-term driver. The short-term issue is a reallocation of people's portfolios. And that's to do with where interest rates are relative to in the USA versus the UK. So the trust shares are basically move in line with UK interest rates, and the trust net asset value and share underlying shares move with international interest rates. And the difference between the two concertinas and drives the discount. There's a limited amount that we can do to do that in the short term, but the answer is basically get the long term. In the short term, the question is getting the drivers. In the long term, the answer is getting the long-term drivers in place, and in the short term, to provide liquidity for those shareholders who wish to exit, to do so in an orderly fashion, in the expectation that the long-term performance is right. But the really big issue, and I want to emphasize this, is that you have to believe, as we do as a board, that what we have here is a story that stands up both in terms of what the managers are doing, in terms of their day-to-day work, which we've been through, and I've explained that to you, and in terms of where the markets are for this kind of thing. And I think both of those, are extraordinary opportunities. So I think that is the answer to the question of discounts. I mean, if it was a simple answer of closing the discounts, that could be done and keep the trust going over the long term, everybody would be doing it. It's just not. Discounts are not a factor that only affects IEM. It affects the whole of the investment trust sector, and for the reasons I've mentioned.
Okay, thank you, Glenn. We've got a question here, which I believe, John, you touched upon, so maybe you can expand on this. How do you see the US administration's approach to climate change impacting fund flows for climate-related investments?
So I think the US election and Donald Trump's elevation to president, it was definitely a negative catalyst in Q4 of last year. It basically did lead to underperformance of renewable energy, but bigger than that, it led to expectations of tariffs and trade wars, inflation and higher rates, all of which are a challenging backdrop for performance in smaller cap companies and some of the sectors we invest in. So there was definitely a challenging Q4. But if you take a step back from that and think, what does Trump actually mean for the fundamentals of environmental markets? Our argument is that it's actually much more nuanced, that there are sectors that he is taking aim at, particularly renewable energy, and also the subsidies and support for electric vehicles. But outside of that, there are multiple sectors that can thrive under a Trump administration. So, what is Trump focused on? He's focused on growth. He's focused on domestic opportunities and reshoring of manufacturing. So we have multiple sectors that can thrive in that environment, whether it's buildings, energy efficiency, water infrastructure, the waste management players. We've talked about clean harbors as a solution provider for industrial haz waste in North America. So the market perception is that Trump is very bad for environmental markets and for IEM, but we would say that is definitely not the case. First of all, in terms of what he is looking to do, I'd also add that federal policy is only one part of the jigsaw in the US. There's a lot of state and local policy, corporate decision making, which continues to drive growth. And I'd also say it's we're operating in global markets and investing in a global fund, so we can move to where the better growth prospects and attractive valuation is. So I think it's overdone, this concern about Trump, but it's exactly what we saw in 2016. But hopefully that's clear.
That is clear and comprehensive. I think we've got time for maybe a couple more before we hand over to Glenn to wrap up. Fotis, maybe you could take this specific one around earnings and historic earnings growth, because I know that's something that you're close to. So the question itself is, is average portfolio earnings for the next 5 years expected to be around 16%? I think that's a question about the forward earnings growth. And then what has it been like for the last 5 years? Maybe we can provide some information around historic earnings growth and forward looking.
Yes. So, just to be clear on what the slide was showing, this is looking at next 12 months versus last 12 months earnings growth. And these are consensus estimates. Excuse me. Now, as to what has earnings growth been in the past 5 years, I would say we have seen the IEM thesis around, going back to the very first slide that I was talking about, which is that we invest in these companies because we believe they deliver superior earnings growth. And, we have seen that happening in the past 5 years. We did have, as I said, a few things happening that meant that there's been a couple of single years that, global equities grew earnings faster than IEM, and that's been mainly because of outsized growth in mega cap AI companies. It's been, on a year that energy as a sector had very strong earnings growth with it lag, but we have generally seen that playing out. So that's what I would say. I don't know, John, would you add anything to that?
Sorry, I was struggling with screens. So yeah, I mean, what we've said is that the historical CAGR was 7% over the last 5 years, right? That's delivered growth. If you look at kind of longer term expectations, I was looking for the report. It's in a high single digit type range. So the long term expectations are consistent with the short term. The kind of delivered growth that we've seen over the last 5 years. Obviously, the bigger number for the next 12 months also reflects coming from a low base, normalization from some of these disruptions. So I think that's what I would add to it. Hopefully that's additive.
All right. Thank you both, John and Fotis. I think that leaves us in a good place to wrap up. So Glenn, over to you for some closing remarks.
We have our AGM coming up this year on the 20th of May. Shareholders are all invited to attend if you can in London. If you can't attend, please vote on the resolutions. The board is recommending that you vote in favour of all the resolutions there, including the continuation vote. We are very keen to involve more retail shareholders, particularly to get more retail shareholders to vote in our AGMs, and to involve more retail shareholders in the governance of the trust and as shareholders in the trust, of course, going forward. So that's the message I think I'd like to leave you with. But I just want to re-emphasize some points that we've made here. The trust is a thematic trust. It is investing in the kind of companies that are going to be investing and are going to be developing stories and solutions around energy and food and water and housing that are under pressure from the environment for the rest of the 21st century. This is not a story that's going away. In fact, it's a story that's coming up upon us faster and faster and faster. I'll just give you one statistic that I heard this morning. In 2024, electricity demand grew faster than, as John has said, faster than it has grown for many, many, many decades. But the biggest single element of that growth was not AI and was not data centers. It was air conditioning, because of a very hot summer in China, in India, and in the USA. And the technology around that, would you believe it, is the heat pump. And heat pumps basically are the technical solution, virtually the only technical solution for air conditioning. And you can imagine that whether we go for net zero or not, this is going to be very important. So this is the first bit of that story. The second bit of that story, we've talked a lot about earnings here, so I won't go over it here, but we have a big earnings story here. And in the end, this is what drives valuations in the market. And the third bit here is we have in IMPAX, and John and Fotis, whom we've heard today, a team with depth and talent and financial resources to be able to create the kind of portfolios that make sense in the long term for investors in this area. Many of the companies that they are researching and they are investing in are simply not in anybody else's portfolio in the UK market. I believe, I'm sure someone will tell me I'm wrong here, that share in cattle is only held in 2 portfolios in the UK. In the whole of the UK market, there are only 2, and it's the biggest battery company in the world. So I think those 3, and that's a bit of research done within IMPAX, and I do investing myself. I'm very impressed by that. So let me bring that story together. Those are the 3 elements there, and that is the platform around which IEM is based. So I'd love to see you on the 20th of May in London if you can, and if you can't, please vote the shares. Thank you.
Perfect. Thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. On behalf of the management team of IMPAX Environmental Markets PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.